Well, if you are confused about what's going on in the markets, you are not alone. Former Treasury Secretary Larry Summers, in an interview with Bloomberg TV, saying that this is as difficult an economy as to read as I can remember. Let's bring in Brent Joyce, Chief Investment Strategist at BMO Private Investment Counsel, and James Callahan, Associate Portfolio Manager at Barometer Capital. Gentlemen, thank you so much for being with us. And it certainly is a day where there's some confusion, there's some mixed signals. How are you thinking about it? I'll start with you, Brent. If we're on the eve of a recession, somebody needs to tell the people who's assembling the economic data.
Absolutely. Unbelievable jobs number this morning. I'm very encouraged that the wage numbers within the report were on the good side. You know, they're not revving up, despite the fact we've got all this job creation. And somebody needs to tell corporations on their earnings calls.
Yes.
All right? Like, we're hearing a lot about preparing for slowdown and things are getting softer, and yet hiring continues.
But we see evidence of a slowdown, right? It's showed up in Alphabet, it's showed up in Amazon, it's showed up in Apple. Their results definitely showed some kind of slowdown, and they're not necessarily telling us, James, that things are going to ramp up anytime soon. And yet, you know, some of these names are starting to go higher.
Absolutely. I think that companies are taking the opportunity to give cautious guidance now. Like, for example, with Apple last night, normally we would get concrete Q1 guidance and full year guidance, and instead they elected to just give, directional guidance on business lines. So I think companies are taking the opportunity to reset expectations. And
I think that brings up a good point, that these companies are, if they're offering forecasts, it's verbal, it's not hard targets that they want to hit. So we're not the only ones that are confused. I think businesses are seeing the economy unfolding as a moving target.
Yeah, well, I think we have to remember that the aftershocks from the pandemic and the shocks now from the tightening last year are still flowing through this economy. And Larry Summers is right. It is a very difficult environment.
So how do you invest in that environment? Because you can invest knowing inflation is high and the Fed's going to increase rates, or you can invest knowing that the opposite is true, but it feels like right now we don't know which of these scenarios is going to play out.
Well, we look at the price action, and right now it seems like there's animal spirits back in the market. It's been really nice this week to be able to get out and play some offense. We've been playing defense really for over a year now. So it's great to see price action confirm, some of the positive commentary from the Fed earlier in the week. So we feel quite good.
What about you?
Yeah, animal spirits, fine. Happy with that. I am a little concerned about some of the speculative areas of the market. You look at crypto, you look at some of the meme areas. This I had hoped had been scrubbed, this sort of fervor and speculative behavior with last year's price action. And so I'm not too pleased to see those things racing ahead here. But good quality companies making a change and adapting into this environment, all fine with those share prices.
I love the word quality, because I always say, people always come on the channel and they say we want high quality names. Nobody ever says we want low quality names, but low quality is actually what's working. Money losing businesses, high short interest businesses. Does this tempt you to put in some low quality, tuck it into the portfolio?
Not at all, no. It is. It's concerning, like I said, that we have maybe not learned all the lessons that we need to learn after last year's, what I had hoped was a cleansing. And I think this is somewhat short-lived. It's a bit of a breath, I guess, because of where the bond market and where yields have gone. But I don't think it's a new revolution for these stocks.
So if the animal spirits are out, maybe not unleashed, but poking their head out like those groundhogs to see how things are going, are you following the trend? Are you piling back into tech a little bit more? Where are you finding opportunities?
Yeah, I wouldn't say piling back in. We've definitely been adding some tech exposure over the last few weeks as we've started to rotate out of some of the sectors that worked so well last year, which were more defensive equity sectors. So, we've been adding tech, but I won't break ranks from other guests and say, we do like the quality names too. So we've been adding to semiconductors, names like NVIDIA and AMD and things like that, quality names that have reset expectations.
Which is interesting, because you think about semiconductors as almost the new industrials, telling us where the economy is going. Is it a growth play?
It is a growth play. And it's an AI play as well for us. We've been doing a lot of work on ChatGPT and AI proliferation, and NVIDIA is the key beneficiary of that. So We do think longer term that plays out in more demand for GPUs.
When you're looking for quality, is it away from defensives, which did very well last year, or are you still holding on to those?
For us, you can find quality just about in any sector. In a market that we think is going to be a little more difficult this year, we've got this tightening to deal with. All of the clouds have not parted, despite the brighter tone from the Fed chair earlier this week. And we're happy to see the economy doing better than people had expected. But now it's a show-me environment. We want to see businesses adapting to these higher borrowing costs, this labor market, taking market share. So Ford's a good example of that. When you look at businesses that can manage their costs, and it's going to become a fundamentally driven and stock-picking environment, business by business.
So you like Ford?
I'm not the stock picker here. You can ask James.
Well, I was just, I guess I'm trying to get a sense of when you talk quality. What are some of the characteristics that you're looking for that screen is very important?
Yeah, this is going to sound like a broken record, I think, to many money managers. You want good products, right? Great products, good companies that are well managed, areas where there's moats around these businesses for their customer base. So Apple certainly fits that bill. And cost consciousness in this environment. It's not a tide floats all boats, which is why the junkie end of things rallying here is what concerns me. I don't think we're back to game on with easy money and liquidity. That's not coming.
Well, but you did mention Apple, and the price action. I know, James, you've been following is interesting. The initial reaction is sell-off, or reaction to a slowdown, and only very small bits of good news that the company was willing to offer, and yet the stock's higher. What does that tell you?
It really is only small bits of good news. Like for us to look through the Apple quarter, I guess the main message to take away is stagnation. Mm-hmm. So the products business will stagnate. We're out of an iPhone cycle, as we had been in for the past 2 iterations of iPhone. So I do think it's just confirmatory of green shoots in equity markets and adoption of a risk-on posture. I don't think it has much to do with Apple specifically.
So are you both confident that we're going to end the year higher?
On stocks?
Yeah.
From these levels, yeah. We might be a little bit ahead of ourselves here in the early days. You don't straight line January's performance and February's performance through to the end of the year. And I wrote recently that we've sort of put in about half of the return I had penciled in for the year. And I was at the upper end of forecasts on the street in December. So there's money to be made, but short-term pause wouldn't surprise me.
And for me, I need to look at the price action. So I think the odds are in our favor, but it's too early to say.
What about this idea of where leadership is going to come from? Because if it's going to come from tech, I wonder about the TSX's ability to outperform. It outperformed last year. There's a couple of notable people that are calling for outperformance again this year. How do you think about that, or do you think about that, where that outperformance is going to come from?
Yeah, I have concerns that we've seen the best days for leadership from the technology space. When you go through long periods here of that extended leadership, when it does break, it does tend to take some time to repair itself. For the TSX, you would think that would be a negative. On the other hand, one of the most hated asset classes for the last 10 years has been energy. Mm-hmm. Huge move in energy over the past 2 years. But I do think that we have had a structural change in how we look at global energy now that has some legs for it.
And for us, we've been adding to tech, but we have been favoring for some time materials. So we do like the mining stocks, gold and copper, companies that are able to, with higher commodity prices, continue to grow their dividend quite nicely. So we've taken a barbell approach.